countries. We had an SL crisis, Scandinavia had its crisis, and in each case, the financial sector, the banks, were bailed out, as they have been bailed out in this case. But because they were bailed out, they came to believe that the markets were working because things didn't fall apart. But the reason they didn't fall apart, the reason that things didn't get worse and worse, was that governments had to repeatedly come in and save them from themselves. And so you've had bailout after bailout. Most of these bailouts have names of countries: Korea, Indonesia, Thailand, Argentina, Brazil, Russia. I could go on. It's a long list. But actually, these are not bailouts of countries. These were bailouts of banks, of the financial system, who had not performed their key role of ascertaining creditworthiness and lent money beyond people's ability to repay. And when they couldn't repay, governments came to the rescue. Well, the result was this mistaken view, as I say, that markets work, and rather than re-regulating, what they did is they continued in the path of deregulating. They didn't adopt the new regulations required for the 21st century or even the late 20th century. In the United States, we passed a law. As the problem of the derivatives were getting larger and larger, as they became more and more apparent, as the Federal Reserve helped organize a bailout of long-term capital management. I don't know if you remember this in 1998. One hedge fund's failure threatened to bring down the entire global economy. One hedge fund had exposure of $1.5 trillion. And in response, in the US Congress was to pass a law saying that derivatives could not be regulated. And some of the people who were responsible for that are still in charge of the US financial system. Well, not surprisingly, with this mindset, we also appointed regulators who didn't believe in regulation. And with regulators who don't believe in regulation, you're not going to get very good regulation. And so it's not a surprise that you have people like Alan Greenspan surprised that we had a financial crisis. The interesting thing is that actually during the past quarter century, economic theory has provided a much better understanding of why markets are often not efficient or stable. In the introduction, was referred to work that I and other people have done on asymmetric information or imperfect information. The bottom line of that research can be put very simply. One of the most influential ideas in economics is Adam Smith's invisible hand. The idea that the pursuit of self-interest leads as if by an invisible hand to the well-being of society in general. Well, what our research showed is that the reason that the invisible hand often seemed invisible was that it wasn't there. Or to put it another way, I don't think anybody would say that the bankers' pursuit of their self-interest, their greed, led to the well-being of society in general. So to put it very bluntly, Adam Smith was wrong. And we understand the sense in which he was wrong and the sense in which he had some basic insights. But unfortunately, many of the policymakers didn't understand that, and many of the policymakers today don't understand that. I won't mention who, but one of the candidates in your elections has been citing some of the economists who still believe in Adam Smith's invisible hand. You can figure out who that is. Well, the bubbles allowed everyone to live beyond their means. And that was one of the reasons the regulators didn't want to do anything. There was a party going on, and nobody wanted to be a party pooper. This was especially important in America. We were discussing before this meeting a very different picture between America and Australia. In America, most Americans' incomes have been stagnating. GDP has been going up, but it hasn't been widely shared. In 2007, for instance, before the crisis, most Americans' income was lower than it was in 1999. Their incomes have been going down year after year. All of the increase in GDP has been going to a few people at the top. So it isn't trickle-down economics that growth benefits all, it's been trickle-up economics. People at the bottom have been giving up income so the people in the top can enjoy ever more. Well, in order to avoid lowering their standards of living, what we told people, don't worry about the fact that your income is going down, spend as if it's going up. And the one thing that Americans do very well is spend. Now, there's only one way, if your income is going down and your spending is going up, the only way to get to square this particular circle is to borrow. And they did that. But what allowed this to happen was this real estate bubble, the housing bubble. So they thought they were getting wealthier and wealthier, even though they were spending more and more, and their incomes were going down. Well, it was clearly not sustainable. It's not feasible for incomes to be going down and house prices to be going up. You don't have to have a PhD to figure out that you can't spend more than 100% of your income on housing. Well, it should have been clear that this was not sustainable. And as one of my predecessors as chairman of the Council of Economic Advisors said, that which is not sustainable won't be sustained. And this wasn't sustained. But it wasn't only the households that were living beyond their means. In a way, governments were too, although they didn't fully understand it, because they were getting income, tax income, from the housing bubble. They were getting capital gains. They were all sharing in this bubble. So even the United States was not a prudent economy. We were spending beyond our means, but there were other economies around the world. Spain had a surplus on its budget. It thought it was doing very well, but it was spending money that was phantom money. It was spending money that was based on tax revenues based on the bubble. Globalization and financial and capital market liberalization allow these toxic assets, these bad mortgages, and I can't here describe how bad these mortgages were. We invented concepts, part of the innovation, we invented a concept called low documentation loans, more familiarly known as liar loans, where you could say down whatever your income was that they figured out, the mortgage broker told you what income you needed to have to buy the house that you wanted to buy, and then they would write that down, and since you didn't have any documentation required, that was what showed up in the form. So this was where the innovation was. It was actually quite marvelous. Unfortunately, people in the rest of the world didn't fully appreciate the creativity in America. And as I said, globalization and financial and capital market liberalization allowed us to sell these toxic assets all over the world. The securitization process that was widely vaunted was based on what I call the greater fool theory, that you could always find a fool foolish enough to buy these assets. And globalization had opened up a global marketplace for fools. And our marketing found them all over the world. But a lot of them, most of them actually, we found in Europe. 40% of our toxic mortgages we sold to Europe. And when I give a talk in Europe, I always thank the regulators there for inviting our mortgages in and for buying so many of our toxic mortgages. Because if they hadn't bought 40% of our toxic mortgages, the downturn in the United States would have been much, much worse. So I can't thank Australia quite as much as I thank New York. You didn't buy that many because you had the misfortune of having good regulators. Well, the problem today, in a nutshell, is bringing the world back to reality. The question is, what will fill the gap in aggregate demand left by the bursting of the bubble? It's clear that, focusing now for a moment on the United States, the consumption won't, or at least it shouldn't, return to where it was. The household savings rate in the United States fell to 0. And that clearly is not a basis for long-run prosperity. In the East Asia crisis 12 years ago, the countries recovered fairly quickly, but it was on the basis of exports. Korea, Indonesia, Thailand could export their way out of recession. But it's clear that with this being a global crisis, the United States, Europe, not everyone can export themselves out of a crisis. Trade with Mars remains sufficiently limited that not every country on this planet can export its way to prosperity. President Obama, in his State of the Union address, had said that he had hoped that we could increase our exports significantly. In the Great Depression, countries tried to get themselves back to prosperity through beggar-thy-neighbor policies. What they did is they increased tariffs and so took their limited amount of demand and said, we'll spend it at home rather than abroad, and that will get us prosperity at home. It didn't work, though, because everybody else retaliated, and it was part of the downward spiral that led to the weakening of the global economy, the Great Depression. There was a second, today people aren't doing that, or aren't doing it very much after the G20 meeting in Washington, where they all agreed not to engage in protectionism. 17 of the 20 countries ran home and enacted protectionist measures. The United States was the most famous. We had a Buy America provision in our stimulus package. And then when it was pointed out that it was probably WTO illegal, we put a clause in that said, except with countries that we had a procurement agreement, which meant that we would only not buy from poor countries with which we did not have a procurement agreement. So we decided to really target those countries who were the innocent victims of the crisis. But the main mechanism today for this kind of beggar-thy-neighbor policy is called competitive devaluation, where you lower your exchange rate relative to that of your competitors. When your exchange rate gets low, your products are cheaper and you sell more. And while every U.S. Secretary of Treasury says he believes in the strong dollar, if you look what they're doing is they're trying to get the dollar weaker and weaker. You just don't want to admit that you believe in a weak dollar. So we've been engaged in this kind of, our hope was that we would get the dollar down and that would help our U.S. exports. But exchange rates are what I call a